All right, everyone, welcome back. We are so pleased to have you here. We're also pleased to have Peter Schiff, the chief economist and global strategist of Euro-Pacific Capital. He is one of the few widely known economists and investment professionals to have spoken out about the financial crisis before it began. He is a widely followed opponent of debt-fueled growth policies and known for his advocacy for emerging market and commodity-focused investments in countries with positive fiscal characteristics. Peter, it's always an honor. It's all yours.
Thanks for hosting me. It's always a pleasure to address the Money Show audience. And you know, people who attend the Money Show are interested in making money, obviously. And you know, one of the ways that you make money as an investor is to take advantage of situations where you have a mispricing of assets. Because if the market perceives, let's say, a stock to be worth more than you know it is, that there's something flawed in their analysis and it's causing the market to overprice an asset, that gives you an opportunity to make money by selling that asset. Same thing as a buyer. If the market fails to assign an appropriate value to a particular stock, if you believe that the market is wrong and that the stock is worth a lot more than what the current market price would indicate, well, now you have an opportunity to take advantage of that misperception because you could buy the stock at a much lower price than what you know the stock is worth. Well, I think that is exactly what's happening right now on a much broader scale, because all sorts of asset classes entirely, not just individual companies, but asset classes are extremely mispriced because the market really has no idea what's about to happen and how it's going to impact the value of those assets. You know, it reminds me a lot of the subprime mortgage bubble, because early in that bubble, you know, 2004, 2005, 2006, it was apparent to me that the market had mispriced these bonds, that the bonds were trading actually above par, when in my opinion, they were worth zero. I understood the dynamics behind these securities and the housing market, which ultimately was how these securities derive their value. I knew that when real estate prices dropped, and that a drop was inevitable, but that was something that buyers of mortgages couldn't even conceive was a possibility. I knew that when prices dropped, there would be a wave of defaults and that these securities would ultimately be worthless. And that created an opportunity to short them. And there were several other investors who achieved a degree of fame and fortune by coming to the same conclusion. But the reason that people were able to sell these mortgages that were basically worthless and sell them at above par was because the vast majority of investors were clueless as to what was actually going on. And it's those same clueless investors that are now overpaying for US bonds, for the US dollar, for US stocks, and who are undervaluing things like gold and silver and maybe emerging markets and value and dividend paying stocks relative to growth stocks. And before I get into the economy, which is, I noticed, was the topic of my talk, the recession that everybody denies exists, I want to start off by talking about inflation, because that's actually the bigger problem, and that's what's driving the recession, and it's what's also driving, I think, the misconception as to how assets should be priced. Going back to the beginning, for years, the Federal Reserve told us, the public investors, that the problem was inflation was too low, that the Fed had decided that 2% inflation was its target. It was no longer a ceiling where inflation had to be below 2%, which is where the 2% even came from. The Fed decided to redefine that ceiling as a target. And the Fed told us that we needed 2% inflation, that anything less was unacceptable, that somehow if the cost of living did not rise by 2% every year, it was bad for the economy. That if the cost of living only went up 1.5%, that was a problem. The problem that the Fed was going to solve by making sure that the cost of living went up by 2% per year. And the way the Fed was going to deliver on that promise was through monetary policy. So the Fed kept interest rates at zero, and they continued quantitative easing because inflation was still below this target that they decided was somehow the economic sweet spot when it comes to inflation, that we need to accept a 2% increase in the annual cost of living because anything else could be economic disaster. So the Fed pursued this policy. Then, when the Fed actually achieved its goal, when inflation started to come out at 2% or even slightly above, the Fed did not declare victory. No, the Fed said it still had more work to do, because the Fed said that even though we're at 2% inflation now, that's not good enough. We need to make up for all the years that inflation was below 2%. So that's when the Fed all of a sudden redefined its 2% target to a 2% average. The Fed said that inflation must average 2% over time. And because we had so many years below 2%, well, now we need to have years above 2% to average all that low inflation back up to 2%. Now, of course, all this was nonsense from the very beginning. I said that it was nonsense that the Fed claimed that we needed 2% inflation, that 2% inflation was not better than 1% inflation. Actually, the opposite. 1% is better than 2%, and 0 is better than 1%, and minus 1% is better than positive 1%. When it comes to the cost of living, the lower the better. If the cost of living goes down, that means the standard of living goes up. So it was nonsense that the Fed said we needed more inflation. And it was even more nonsense when the Fed said we needed to make up for the fact that we didn't have enough inflation in the past by having more inflation in the future. Now, why did the Fed make this stuff up? Well, they wanted to justify the monetary policy and pretend that there was some kind of benevolent purpose to what they were doing. There was not. The sole reason that the Fed continued to print money and keep interest rates at 1% was to sustain the bubble that it had inflated, both in the economy and in financial markets, and also to sustain the US government, which, thanks to the Fed, had taken on so much debt that the only way the Fed could service that debt is the only way the Treasury could service that debt is if the Federal Reserve kept interest rates as low as possible, which was 0, and continued to buy a lot of the debt that the Treasury was selling. So they continued these policies not because it benefited the public, it actually hurt the public. It benefited the government in their ability to deceive the public, and it benefited investors because the policy propped up asset prices. So if you owned a lot of stocks or real estate, you benefited from having those prices artificially high and the ability to borrow against those appreciated assets at artificially low interest rates. Well, then, after the inflation rate was not just slightly above 2%, when it was double 2%, when it was triple 2%, now the Fed had to address the inflation problem because it was no longer just slightly above 2%. So the way the Fed initially addressed the inflation problem was it dismissed it. It attributed the factors causing the price increases to the reopening of the economy, the pandemic, to Putin, and the Fed assured everybody that there was nothing to worry about, that the high inflation that we were experiencing was just transitory. It was all going to go away on its own. And so the Fed didn't have to do anything. It could keep on printing money, quantitative easing, it could keep rates at 0 because the inflation problem was going to solve itself. It was not until high inflation persisted, and in fact, we ended up getting numbers that were 4 times the 2% target, And now the public was so upset about inflation. The public was complaining. Joe Biden's approval ratings had tanked, mainly because of inflation. And so inflation became such a big political problem that the Fed could no longer pretend the problem didn't exist. And so it finally came out and admitted that inflation wasn't transitory and that it was going to get rid of it. The Fed had the ability and the resolve to extinguish this inflation fire, and it was going to do it. No matter what it took, it was going to bring inflation to an end. And the markets believe the Fed. Now, the market shouldn't believe the Fed because the Fed has gotten everything wrong in the past, especially when it comes to inflation. But for some reason, the markets believe the Fed, and as a result, priced assets for an environment in which we have high interest rates and no inflation. That is what investors expect. They think inflation is going to disappear and interest rates are going to be higher. And that has caused investors to pile into the US dollar. That's caused them to sell gold and silver and buy US treasuries. If you look at the yield on 30-year US treasuries, it's only about 3%. And on a 5 or a 10-year, it's lower than that, maybe 2.7, 2.8. Given that inflation is 9%, although we got data today, now the year-over-year inflation rate has come down to 8.5%. But when you have 8.5% inflation and 3% 30-year bond yields, that shows that investors are confident that the inflation we're seeing today is going to go away. And so therefore, they don't need to be compensated for inflation over the next 30 years because inflation is going to go away because the Fed has promised to get rid of it. But the problem is inflation is not going to go away. Inflation is here to stay. The inflation that we're experiencing today is not simply the consequence of reckless monetary policy since the COVID pandemic. Now, the COVID pandemic added fuel to the fire, and I was very critical of this policy mistake when the Fed first made it back in March of 2020. I was one of the few people that accurately forecast that the pandemic was inflationary, not deflationary, because the pandemic was resulting in a reduction in supply. The proper monetary policy response would have been to reduce money supply so that prices would stay stable. But instead, the Fed did the opposite. It expanded money supply, therefore increasing demand as the markets were reducing supply. Now, a lot of the supply reduction was due to government mandates that forced businesses to close and workers to stay home. So the government ordered a reduction in supply. At the same time, the Federal Reserve delivered a huge increase in demand. In fact, people who used to be on the job making stuff were now at home collecting unemployment benefits that exceeded what they used to earn. So they weren't producing, but they were consuming, or at least trying to consume. And so this was a perfect storm for massive inflation. And I warned about that. But all this inflation has its roots in the 2008 financial crisis and the government bailouts. QE1, QE2, QE3, all of that was inflation. The Fed let loose all of these inflation chickens back then. They're finally starting to come home to roost. And there's a lot more of them out there because initially investors were worried that all this quantitative easing would cause a lot of inflation. And they were correct. In fact, quantitative easing is inflation. It's just inflation by another name. And inflation ultimately causes prices to rise. But temporarily, what happened was a lot of that inflation went into financial assets, went into stocks, bonds, real estate, stuff like that. Now it's migrated into consumer goods, and it is there to stay. The only problem is that there was a long lag between all the inflation that was created and the impact on consumer prices. Well, now we've arrived at that impact. There's so much inflation in the pipeline that nothing the Fed is doing now is going to turn off that spigot. In fact, what they are doing now is completely inadequate for the task at hand, because the only way to get rid of 8% inflation is to have interest rates that are above 8%. You need positive real interest rates so that you change consumer behavior. We need less spending and more savings. Well, no one is going to save more if you still have negative interest rates. If interest rates in a bank account are 1%, and if you can only get 2 or 3% on longer term treasuries, why would you do that when inflation is destroying the value of your purchasing power by 8% a year? No, you're going to spend everything you've got. And if we encourage more spending, well, that's more inflation. And of course, the root cause of all the money printing is the massive federal budget deficits, which are continuing to be $2 trillion plus per year. And ultimately, that spending is not only fueling demand, but it is causing the Federal Reserve, and will cause the Federal Reserve, to have to go back to quantitative easing. Despite the fact that it's talking about shrinking its balance sheet, it's going to be expanding that balance sheet, and that is more inflation. So there is no way the Fed can actually succeed in fighting inflation unless it allows interest rates to rise above the rate of inflation and forces the US government to slash government spending. None of those things is going to happen. And so the inflation problem is going to get worse. And one of the other qualifications that the Federal Reserve has always put on its inflation battle is its willingness to be so tough on inflation, even though it wasn't tough, but it was just talking tough, but its actions speak louder than its words. But the reason that the Fed was talking tough about fighting inflation was because the Fed also claimed we had this booming economy. We had a super strong economy, the strongest economy ever. We had this red hot labor market. And because we had such a strong economy with such a strong labor market, that we could easily withstand the rate increases that were necessary to fight inflation. Oh, and by the way, the reason the Fed can't raise interest rates high enough to fight inflation is because it would create not only a depression, but a financial crisis, because there's no way that all the debtors could pay that debt. And so everything would implode, which is why the Fed is not fighting inflation, because it can't, but it can't admit that. So it's pretending that it will. And part of the pretense was the strong economy that was enabling this fight without the type of collateral damage that there would normally be when the Fed was fighting inflation, even though this time there should be much more collateral damage because we have more inflation than ever, and we have an economy more vulnerable than ever to rising interest rates. But the Fed was hiding behind the facade of this super strong economy. Now, the whole time the Fed was claiming the economy was strong, it was actually in recession. The economy has been in a recession for all of 2022. In fact, back in 2021, when I was a lone voice predicting that inflation wasn't transitory and would get stronger, I was also predicting that the economy would get weaker at the same time. I forecast that the US economy would be in recession in the first half of 2022, and I got that right. But I said, even though the economy would be weaker than anybody thought, inflation would be stronger than anybody thought. So I got both right. My prediction was stagflation, but that the stagnation would actually be recession, not just slow growth. Well, now that the Fed has now been confronted with the data, and I always assumed that once the GDP numbers came out for the second quarter, that they would have to admit that we were in recession. In fact, they shrugged off the negative GDP in the first quarter and still pretended that we had a booming economy. But when we followed that up with a second quarter of negative GDP growth, I initially thought, well, okay, they're just going to have to admit there's a recession. But no, they haven't admitted it. They're still denying that there's a recession. And how are they doing that? Well, they're redefining what a recession means. Because for my entire career, we've defined recession, and so has everybody in government, everybody at the Fed. It's always been defined as 2 consecutive quarters of negative GDP growth. Well, we meet that definition because we just had that. In fact, the declines in GDP are likely bigger than what the government admits to because they are understating inflation in their deflator. So the economy is actually weaker than the numbers indicate. Yet despite those negative numbers, the Biden administration and the Fed claim that we are not in recession, that the recession doesn't actually mean 2 consecutive quarters. It means a broad-based decline in the economy, which is kind of subjective because somebody has to determine whether the decline is broad-based enough. Although from all the evidence that I've seen, it's very broad-based right now. I mean, housing's in recession, autos are in recession, retail, advertising, all sorts of unrelated parts of the economy are contracting, yet somehow that doesn't constitute a broad-based decline. So despite this evidence, the government continues to pretend that the economy is not in recession. And part of that is so the Fed can continue to talk tough about raising interest rates because it's ignoring the damage that those rate hikes have already done and will continue to do. Because as the Fed continues to raise interest rates, GDP growth in Q3 and probably in Q4 will also be negative. And so we could have 3 or 4 or more consecutive quarters of GDP growth. Eventually, the Fed has to acknowledge recession. In fact, as the Fed raises interest rates to fight inflation, it undermines the economy because of all the debt service. It also helps push consumer prices higher because higher interest rates are just another cost that businesses have to pass on to their customers. And it's another cost that individuals bear who have debt. We have record credit card debt, student loans, auto loans, mortgage debt. All of these payments are influenced by higher interest rates. Now, I'm not saying the Fed is wrong to raise interest rates. The Fed needs to raise interest rates. In fact, it's the market that needs to raise interest rates. The Fed needs to get out of the way. That's what Paul Volcker did. He didn't put interest rates at 20%. He got out of the way. And the markets put interest rates at 20%, even though inflation was no higher than 13.5%. And of course, if we still measured inflation today using the same CPI that we used to measure it in 1981, we would be much higher than 13.5%. And the markets would obviously put interest rates maybe even higher than 20% if they were allowed to function. But they're not being allowed to function for the obvious reason that everything would collapse. Back in 1980, we could afford to pay 20% on our debt. We only had about 1 trillion in the national debt, not 31 trillion like we have now. But more importantly, most of that debt was locked in with 10 to 30-year treasuries. So higher interest rates only affected the immediate borrowing needs of the US government. Now, with about 1/3 of the debt maturing every year, we have such a short maturity and we have such enormous current deficits that any big spike up in interest rates immediately bankrupts the US government. There is no feasible way of making those payments. They can't raise taxes high enough to do it. And of course, if interest rates went that high, we would be in a massive recession. And so tax revenues would collapse while government spending exploded. So there is no viable way to allow interest rates to rise to a market clearing level, but that is still the right thing to do. The Fed needs to fight inflation, and it can't do that without pricking the bubble in the economy that was created by inflation. So if you take all the inflation away, then the bubble collapses. We're going to have a massive economic collapse. We're going to have a worse financial crisis than 2008. Stock prices will crash. Real estate prices will crash. Bond prices will crash. The US government will be forced to cut government spending dramatically, even on entitlements like Social Security and Medicare. And it will probably be forced to default on the national debt. Now, that doesn't mean that people who hold treasuries get nothing, but they're not going to get repaid in full. They're going to have to take a haircut. The debt is going to have to be restructured so that the principal is reduced to a level that the US government could actually afford. Now, all of this stuff would be political dynamite. I mean, it would probably be suicide for whatever the party is in power that was forced to acknowledge all this, which is why it is not going to happen. The Fed does not have the political will to force all this to happen. So everything it's saying about its commitment to fight inflation is a bluff. The Fed will give up the inflation fight as soon as it's too politically dangerous to continue it, as soon as the collateral damage is great enough that the Fed has to pivot and then focus on the economy, on employment, on financial markets, because that is what the Fed has always done, and that is what the Fed is going to do. The question is, will the markets start to price in this pivot before it happens, or will they wait for it to actually happen? And what the markets still don't understand is what this means. Because while there are enough investors who understand that the economy is either in recession or headed to recession, those same investors also believe that the recession will do the Fed's work, that inflation will go away as a result of the recession, that as the labor market weakens and unemployment rises, that will also reduce inflation. That is wrong. Inflation is not caused by economic growth. It's not caused by low unemployment. It's caused by the deficits and Fed money printing. And money printing and the deficits are going to go up in the next recession, not down. Now, in the past, that monetization manifested itself in asset prices. That ship has sailed. We're beyond that now. We've gotten to the point where inflation is going directly into consumer prices, and that is going to continue. Oh, and by the way, the idea that the US has a strong labor market is farcical. Just because we have an official low rate of unemployment doesn't mean the labor market is strong. In fact, the 3.5% unemployment rate is 6.7% if you include people that are working part-time involuntarily and discouraged workers. That used to be the actual unemployment number until they decided to change it. But of course, if you include the long-term unemployed, which the U6 excludes, you've actually got an unemployment rate above 10%. That's not a strong economy. You also have labor force participation, the lowest it's been this year at 62.1, and well below where it was before the pandemic started. That is not a strong labor market. Real wages are collapsing. Yes, workers are getting wages, but those wages pale in comparison to the increase in the cost of living. So when you have a labor market where workers are forced to accept pay cuts, that's not a strong labor market. In a strong labor market, workers are able to demand raises, and their employers have no choice but to pay them. And a raise means that your paycheck goes up more than the cost of living, not less. And in fact, people's paychecks have been so significantly reduced by inflation that one paycheck is not enough. You now have a record number of people who hold down 2 full-time jobs. And the number of people with multiple part-time jobs is at a post-pandemic high. In fact, almost all of the jobs, in fact, I think all of the net new jobs over the last 2 months were attributable to people who already had jobs getting second and third jobs, meaning the vast majority of those jobs were part-time jobs. So in a strong labor market, you don't need 3 jobs. 1 job is enough. But in a weak labor market where one paycheck doesn't cut it, that's when you see a big surge in moonlighting, and that's what we have. But the big issue is that, yes, investors are correct who are betting on recession and that the Fed will pivot in the face of recession. But they are wrong to assume that that pivot will represent some type of victory over inflation, either because the Fed hiked enough or because the economy went into recession and that solved the problem. No, this is not going to be the type of pivot that we had back in 1982 that was very positive for stock market, for the dollar, for the bond market, a pivot that was negative for gold, because when Volcker pivoted, he pivoted in success, in victory in his war on inflation. When the Powell Fed pivots, it will be in defeat. Inflation will have won. Inflation is never going back to sub 2%. In fact, it's not even going back to 2%. I mean, maybe not never, but certainly in the foreseeable future for the remainder of this decade and probably a lot longer, inflation is going to be considerably above 2%. We are living in a very different world. In fact, the world that we lived in with sub 2% inflation, that was the exception. This is the rule. That was some kind of fantasy. We are now back in reality. And the reality is high inflation, well above 2% as far as the eye can see. And that means that bonds are woefully mispriced. Yields need to be much higher. Prices need to be much lower. Stocks are overpriced. Their multiples are too high. The US dollar is dramatically overpriced because it's going to lose a tremendous amount of its purchasing power over time, and therefore it should have a much lower exchange rate than the one it has right now. It also means that gold and silver prices are much too low, because right now gold is priced for a world where there is no inflation, where inflation has been vanquished by a tough Federal Reserve that is committed to ridding the economy of inflation. When the markets realize that that's not the case, that the Fed is going to choose inflation as the lesser evil, because that's the choice. Do we have a massive economic collapse, financial crisis, depression, waves of defaults and bankruptcies, or do we tolerate higher inflation? The Fed already made that deal with the devil, and it's going to keep its commitments. We're going to have higher inflation. The markets just need to come to terms with that and price it into assets. And of course, it also means a huge decline in the American standard of living, because I think the recognition of this reality is going to be the final nail in the dollar's coffin. It's going to cause it to lose its status as the world's reserve currency. And so Americans are not going to be able to exchange the money that we print for the goods everybody else produces. We're going to have to live within our means. And those means have been greatly diminished during the years that we've been able to run these massive trade deficits and outsource all of our manufacturing. We've gotten a small taste of those supply channel bottlenecks recently. Well, we're going to get a full helping of it later once the dollar plunges and we really see how much we depend on global supply chains. But again, to wrap this up, when it comes to individual investors, right, we need to take advantage of this situation. You know, I have been preparing and helping my clients prepare for this for over a decade. And the only thing that surprised me is that we've been able to kick the can down the road for as many years as we have. But everything else that's happened is what I predicted. It's just taking place on a longer time scale than I would have imagined over a decade ago. But be that as it may, we're here. And the fact that we were able to kick the can down the road for as many years as we did just made the problems much worse. The bubble has grown much larger during the years of can kicking. And as a result, the collapse is much greater. It means that investors stand to lose a lot more purchasing power if they don't understand what's going to happen and modify their portfolios to account for this. And it also means that the investors who do make those changes are going to make even greater profits, I believe, as a result, because the bigger the bubble, the more air there is to come out. And the more air that comes out of the bubble, I think the more profits that the people make who bet against that bubble. And so that's what we're doing at Europe Pacific Asset Management with our strategies. And there are several ways that people listening to this presentation can avail themselves and participate and hopefully profit from those strategies. We manage 5 mutual funds in the Europe Pacific Fund family. Anybody can buy those funds from any of the discount brokerage firms that have our funds on their platform. If you want some help in selecting the right fund or have a managed portfolio, it's called a wrap program, where we manage your portfolio in a basket of my funds. You can talk to people at Europe Pacific Asset Management or at Europe Pacific Capital. The brokers at either company can help you set up an account and pick the funds or the strategy that is best for you. If you're a larger investor and you want to take advantage of our separately managed account program, you can set up an account directly with my asset management company or Europe Pacific Capital, and we can manage a portfolio that is very similar to the portfolios owned by the mutual funds, except you're not a shareholder in a fund. You own your own account and you can see every transaction that we make in real time, and the account can be customized, and it's also not subject to fluctuations that may result from other investors either purchasing shares or redeeming shares. So I think if you can afford the separately managed account, and there's a higher $250,000 minimum there, my mutual funds you could buy for as little as $2,500. But if you prefer the added benefits of a separately managed account, you should talk to representatives from the asset management company or Euro Pacific Capital. We have several different strategies. And one strategy in particular that I want to talk about is the gold mining strategy that is managed by Adrian Day. And Adrian Day also manages the Euro Pacific Precious Metals Fund. But I think for people who want to speculate and who are willing to assume a higher degree of risk, and that's always the case when you're investing in gold and silver mining companies, I think those assets are among the most mispriced assets in the market, because if inflation drives the price of gold up to 5,000 or 10,000, the markets currently assume that the price of gold is going to stay at 1,800 or lower into the indefinite future. I think the markets are wrong. But more importantly, not only will a much higher price of gold relative to the cost of mining it really help earnings of these gold mining companies, but it's going to cause a lot of gold that markets currently assign a zero value to all of a sudden have incredible value. Because if a gold mining company has gold and it costs $2,000 to get that gold out of the ground, and you don't think the price is going above 1,800, that gold is worthless. It costs more to mine it than you can get by selling it. But that whole dynamic changes. What if the price of gold goes up to 5,000 and the cost of mining it goes up to 3,000? Now you have $2,000 value for every ounce in the ground, and now that value is now going to be factored in to the price of these stocks. So I think you have tremendous opportunity in that segment of the market. For those of you who don't want to take as much risk, I think you can also protect yourself with our other investment strategies that invest in value-oriented companies outside the United States, companies that pay good dividends, companies that sell products and provide services that people need. Inflation is a problem worldwide. The Fed isn't the only central bank that kept interest rates too low or printed too much money. So when you own a business, you want to own businesses that provide products and services that people need so that you have pricing power to raise your prices as your costs are going up. You don't want to be in the business of providing items that people just buy after they finish paying for all the stuff they need. You want to sell necessities, not luxuries. The discretionary items are the ones that are in trouble, because as people pay more money for food or more money for energy and things like that, they're going to have to cut back on other things. And so you don't necessarily want to own stock in those companies, because they're going to be facing a lot of economic headwinds in addition to just higher interest rates and rising inflation. So we are making these calculations when it comes to determining our allocations and the companies we buy. Specifically, all the companies we're buying are designed to thrive in an environment where the US economy is weak, where we have stagflation, where we have high inflation and a weak economy in the US. And I believe that when the dollar finally tanks on this reality, that is going to set off an economic boom outside the United States, particularly in the emerging markets, because those economies have suffered from an overvalued dollar. They are going to experience relief when the dollar is no longer overvalued. And in fact, I think there's going to be big inflows of capital into these economies that is really going to provide a big boost to their economy, and therefore provide a significant increase to the asset values in those economies. I actually do have an emerging market fund that people can invest in, specifically to take advantage of the repricing of emerging market assets, not just the stocks, but the currencies that those stocks are denominated in. Because as the US dollar falls, I think it's the currencies of those countries that are going to rise. In addition, I would encourage the people who are listening to my presentation to continue to follow what I have to say about the markets on a regular basis. I provide my insights generally at least twice a week, sometimes more, on my podcasts. And if you're not now a regular listener to my podcast, you should start listening. You can listen for free on schiffradio.com. You can also listen on my YouTube channel, the Peter Schiff Show. It's the Schiff Report on YouTube. If you want to listen, without any of the commercials, if you want to listen a little early, you can go to Locals. I also have it on that platform for a small fee. So either way, it's important to just follow what I have to say, because it often contradicts a lot of the propaganda that's coming out of Washington and then ends up being regurgitated without changing it in the financial media. How much time do I have left? I didn't get the clock.
Yeah, we have about 30 seconds, so you can go ahead and wrap. About 30 seconds remain, so go ahead and you can go ahead and wrap.
30 seconds, and I guess my timing was perfect. So I want to thank everybody for participating in this virtual event, and at some point, I do intend to make a personal appearance at a Money Show event, and when I do that, I look forward to seeing everybody again in person. But again, thanks everybody for attending, and make sure to follow up on this presentation by talking to our representatives and actually taking action to protect yourself, rather than taking no action and just suffering the losses that I think the vast majority of Americans are about to endure. Thanks again.
All right, Peter, thank you so much for your brilliant insights. Thanks for taking the time out today. Greatly appreciate it.
All right, take care.
And a big thank you to everyone in attendance. Stick around. We have more great presentations coming your way. Also, be sure to check out virtualexpo.moneyshow.com. There you can find all the events that we will have coming up. Go ahead and pre-register for any of those events, and you'll receive email notifications when we do have presenters added. We're constantly adding presenters. So be sure to check out virtualexpo.moneyshow.com and register today. We'll be right back. Thanks for being here.